Today's podcast is sponsored by Delupa. Are you ready to cut through the noise in AI and discover the real impact it's having in financial services? Join me alongside Thomas Lee, the CEO of Delupa, on April 15th at 1 p.m. Eastern for an exclusive webinar where we'll dive deep into the future of AI tooling in finance. We've all heard the hype, but what's the truth behind the tech? We'll discuss how AI is transforming financial workflows and where it's actually delivering value. With Thomas's experience leading a fundamental data company that leverages AI, you'll get firsthand insights into what works and what doesn't in this space. Whether you're managing a hedge fund, analyzing financial data, or simply interested in how AI is shaping the future of finance, this webinar is for you. Don't miss out on valuable insights from industry leaders. Register now at delupa.com/YAV webinar. That's Delupa, DALOOPA.com/YAV webinar for the April 15th, 1 p.m. Eastern webinar, and get ready to uncover the truth about AI in finance. All right, hello, and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on one of the fastest repeat appearances in podcast history, fresh off the just smashing success of the Groupon podcast. I'll refer people to that podcast and the stock price for all the background there. But anyway, Marc from Windward Capital. Marc, how's it going?
Great. Thanks for having me on again. I appreciate it. Good to see you. And the one thing I'd say about Groupon is we actually think it's an easier buy up here than it was when we pitched it post earnings. So we're very excited. And it's actually a bit shocking that short interest has climbed versus where it was going into the print. We get a two-day lag data, and it's just eye-popping that it continues to grow.
It's been a screamer, but not what we're talking about today. Before we get to what we are talking about today, I'll start this podcast the way I do every podcast. Disclaimer, remind everyone that nothing on this podcast is investing advice. Please consult a financial advisor, do your own work, all of that sort of jazz. So, Marc, all that out the way, the company we're going to be talking about today is Turtle Beach, the company that it used to trade under back when I first looked at it. It traded under here, which was a great ticker. Now it trades under TBCH, but I will just pause there and turn it over to you. What is Turtle Beach and why are they so interesting?
Great. Thank you for that. We have quite a bit of long history with Turtle, going back 3 years or so, and we'll get into that in a few minutes. But just high level, what they do, they're the market leader in gaming peripherals. Pretty attractive market, $11 billion market, growing mid-single digits. They have number one market share for gaming headsets, and they've entered through a very accretive acquisition through PDP, the controllers market. In both those markets, they're about 40% or so market share for console gaming. So think Xbox, PlayStation, and now the upcoming Nintendo Switch that we're very excited about. We'll get to that in a minute or so. We think this is a very attractive market with global gamers growing 3+% and the overall market growing mid to high single. These guys have consistently taken share. And, an interesting stat is that they're the best-selling headset brand for the last 15 years and sold over 80 million headsets. So give you a little flavor for what they do. It's an underfollowed mid-cap stock that does not have a tremendous amount of coverage. Interestingly enough, Tony Stoss and Craig Hallam initiated yesterday with a $23 price target, but it's not a very well-covered stock and doesn't trade a ton. So there's a very large disconnect between the multiples at which this company trades and some of the peers like a Logitech or Corsair. Why we're so interested in Turtle, and we think the inflection is now, is several-fold. Number one, it's extremely cheap. On stated numbers, it looks like it's trading around 5.5 times EBITDA, but the balance sheet, it doesn't really fully reflect what's going on. Number one, they pre-bought some inventory, getting ahead of tariff, number one. And then number two, you have to understand how the working capital flows, much like with Groupon. They have to build inventory going into holiday, and then you have a big receivable flush coming in Q1. So pro forma for the Q1 pay down, this thing is extraordinarily under-levered against where we think that they should be comfortable. So what's super attractive from just a capital structure perspective, we believe that this company could be 2 turns levered. And if you look at what needs to happen to get to 2 turns levered on their guidance, which we think is fairly conservative this year and assumes significant tariff headwind, we think that there's 150 million of powder, which is just a real eye-popping number when you look at a market cap that's $285 million or so. So, and that is a good segue to understand the history and what's transpired. And perhaps I walk you through what's gone on for the last 3 years, where we're at now, and the catalyst path here.
No, look, I think you should dive into it. I normally start off with why is this an alpha opportunity, but I think you effectively laid it out there. So please, I know there's a somewhat storied, somewhat tortured corporate history here. So why don't you just dive into that?
Yeah, and by the way, the answer to your question, and then we'll come full circle, is we think there's a massive buyback capital allocation event in the imminent future, coupled with significant inflecting fundamentals because of self-help and industry tailwinds such as the Nintendo Switch and some really attractive game releases coming, GTA 6 namely being probably the best game release we've seen in the last decade. So going back to the history, look, we got involved in this stock in the really around these levels, about $16, actually slightly higher, going back to 2022, when actually a current board member, Will Wyatt from Donerail, made a public bid to buy the company for about $36. Why we were interested is when we did the work on the company, we thought that under the prior management, Jürgen Stark and a very closely held board of cronies, we felt like he was making dilutive acquisitions to drive revenue at the expense of dilutive EBITDA. He was enriching himself and paying himself very handsomely. We thought that there was a nice opportunity to improve EBITDA margins and felt like the upside case made a lot of sense. What we got wrong at the time, and this is a knock on kind of something we learned from, at that time in 2022, the market was in a difficult place and many companies were undergoing significant negative earnings revision cycles. And we spent a lot of time focused on the event angle and less so on the fundamentals, which had some really idiot things that were, looking back, probably easier to see, but at the time really escaped us. So what happened is you have this very vocal, activist that made a public bid, launched the proxy contest, and 2 days before they were set to go to ISS Glass Lewis, they reached a settlement agreement, which effectively read that if the company was still a public entity within 120 days, Donerail would gain control effectively through control of the non-gov committee and would get control of the company, which we thought was a very attractive outcome. What unfortunately went awry is that hangover from all the supply chain shocks during COVID, you had an inability to secure chips, which therefore created a real dearth of supply of Xboxes and PlayStations. And just for the viewers to understand, the real drivers of demand for buying peripheral equipment is either one, you're buying a new console, two, there's new software that's out, which drives you, whether it's a Call of Duty, GTA 6, a Fortnite, or just replacement demand. These things generally have 3 to 4 year cycles in terms of replacement demand. You were coming off of obviously a massive bolus of demand during COVID. So there was some pull forward. But what really hit us at that time was you had a lack of inventory of the console. You had really no software being put out because obviously during COVID, much like you're seeing in movie studios, you saw a several year kind of hiatus of real developments. And then when we really got caught off guard was the retailers had about 15 weeks of inventory, and they cut their inventories from about 15 weeks to 7 weeks. So it was a really damaging time for Turtle because now they had inventory that was building on their balance sheet. The sell-in got cut by about 50%, despite sell-through really only being down 7-8%. So EBITDA flips extremely negative. And what exacerbates the situation is that despite having a legal settlement agreement to take control of the board, Jurgen and his team decided they're not going to give Donerail the board seat. So it becomes a drawn-out battle. Then it becomes a tax loss selling candidate. Stock goes to 6. And it wasn't a fun maiden year for Windward. That was the year we launched. And this was our biggest loser of all time. We lost 770 basis points of the position in 2022 and was actually almost 200% of our gross loss that year. That being said, we're still here fighting and really love the position. And I think Will and his team have done a great job. Obviously, they've now gained control of the company. Jurgen's gone. They promoted the head of sales, Chris Kern, to be CEO. And really have since then have executed phenomenally. I mean, these guys announced a very accretive acquisition in PDP in March of last year. Synergies have gone higher. It looks like they've done this at 3.5 times pro forma for synergies, if not lower, because there's a very interesting top line synergy. We're generally not top line synergy folks, but what they acquired in PDP, in addition to the scale of now, instead of being a one product company, now having scale in both controllers as well as headsets and simulators. They also got control of this very valuable Nintendo license. So there's very few folks that have a license to be able to operate with Nintendo, and with the Nintendo Switch, and rumors are tomorrow there's going to be a pretty big announcement on Nintendo Switch. I think 150 million global units were sold under the last Nintendo Switch, and we think this is going to be a very big driver for them. They now not only have the tailwind on the legacy PDP business, but also now to cross-license with Turtle Beach. So we think that this is a huge driver for them. So net-net, this PDP acquisition was extremely accretive. But what was really interesting is they already had a very attractive self-help opportunity within core Turtle because of the issues I referred to earlier with Jurgen, elevated sales and marketing, elevated R&D. We felt that core legacy Turtle had a $20 to $30 million EBITDA bump from the self-help, plus call it 20 million of legacy PDP EBITDA, plus 15 million of synergies, and a la that gets you to a normalized EBITDA number of about 80 million of EBITDA in 25, which is where we think that they would have shaken out if it weren't for some of the tariff headwinds which they've guided to. Despite guiding to tariff headwinds, they still guided EBITDA ahead of the street on their last earnings call. But what really is super interesting is when they announced PDP, despite having a very unattractive term loan in terms of rate with Blue Torch that was SOFR plus 7.25, and being levered 1+ times at the time and having TTM EBITDA of 11 million versus TTM EBITDA of almost 60 million, they still were going to buy back 20+% of the company in a tender up to 15. Now, think about that for a second. The stock's below 15 now. EBITDA is up significantly. Forward EBITDA is up significantly. Leverage is now pro forma for the cash coming in for Q1 is now going to be sub half a turn. We think that the company has been waiting for this timing to be in a position to use their excess powder and do a massive buyback, which we think happens imminently. So you've got buyback coming, beat and raise, we think, off of a very conservative bar pro forma for tariff. And I think there's a lot of upside from GTA 6, from Nintendo Switch. Now, granted, this is a little bit of more back half weighted story, but we think that that's significantly intrinsic in where the stock's trading, given it's trading at a 20+% free cash flow. I don't know about you. I don't come across a lot of companies that have 40% market share, high teen EBITDA margins, and are growing high single digits that trade at a 20% free cash flow yield. They're about to buy back 25 to 35% of companies. So maybe I'll pause there. I know that was a lot.
No, that's a great history, and I remember the event very well. Let me ask a few questions. So Turtle Beach, right? If you know Turtle Beach, you probably know them through the headsets. As you mentioned, they buy PDP and they make the, if you want a better Xbox gaming handset, PlayStation, Nintendo, they make those. So let me just start with the first question.
Sure.
I think when I've looked at this, like I remember when Donerail put out that deal and it was at a big multiple, and a lot of you were saying, hey, there's a lot of low hanging fruit at this company if somebody takes over. I guess the thing I've always struggled with Turtle Beach is I look at it and I say, hey, isn't this the most commoditized of commodity business? Like I go online and I put in gaming headset and I get as low as, $20 knockoff gaming headset on Amazon that's effectively Amazon basic drop shipping from China. And then on the high end, there's some Logitech, and I want to talk the comps in a second as well. There's some Logitech and Turtle Beach headsets that are going for hundreds and hundreds of dollars, right? So I just look at it and I wonder, isn't this just like an extremely commoditized, what I call a cost of capital business, right? Like why should this trade for a strong EBITDA or free cash flow market multiple? Shouldn't it trade pretty low because it's a cost of capital business? And I guess the one other thing I'd say there is, they bought PDP. I think pre-synergies, it was about 9 times EBITDA. Post-synergies, less than 5 times EBITDA. So post-synergies is a really good number, really low number. Pre-synergies, actually a decent multiple. But I look at those and say, hey, should this business really deserve more than 6, 7 times EBITDA?
Well, look, I mean, I think what you're saying, I think that the numbers tell a different story. I mean, these guys have 40% market share and have high teens EBITDA margins and have consistently taken share over the last couple of years. And they've been the number one selling brand for the last, 12 plus years. I think if it was such a commoditized business, margins would be going the wrong way, not up. I also think that they wouldn't be continuing to take share. So they also have hundreds upon hundreds of patents, and they have very strong relationships with the console OEMs, and they have scale. And I think they continue to prove it out year in, year out that they continue to grow, take share, and grow their margins. So I think the numbers tell a little bit of a different story.
That's a perfect answer. Let me go to, so that's on the low side, the commodity. I guess the other side, Turtle Beach is not shy about it. You mentioned it. Logitech, Corsair, and I don't know GN. I can't claim to be experts on any of these companies, but they put it in their decks, right? They say, hey, Logitech, people can go look it up. Logitech trades for 11 times. Now, Logitech does have other stuff than this gaming, Corsair, GN. These guys trade for kind of low double-digit EBITDA multiples.
Right.
So Beach will say, hey, we're sitting over here trading for 5 to 6 times. All of our peers are trading for double. The EBITDA margins to me, the EBITDA margins, the financial profiles, it all looks very similar. I realize I'm preaching to the choir here, but do you think these guys should trade for a Logitech Corsair multiple? What's holding them back? Why aren't they trading for it? What's the difference?
I wouldn't. We're value guys. The way we value stocks is we value them off of what we think the appropriate multiple is, not necessarily if a comp is trading at an outlandish multiple. I'm not going to ascribe that Turtle Beach should trade at 18 times. And I don't think Logitech should trade at 18 times. I think Logitech is a vehicle for larger funds to play the gaming cycle, and you can't own Turtle Beach or enough of Turtle Beach. So, these big, huge funds buy Logitech and push the multiple up. And by the way, I would argue that I'd rather own Turtle Beach than Logitech because, in fact, GTA 6 is not being released on the PC cycle this year. It's being released in the gaming console cycle. So that is a very big driver. And then obviously Nintendo Switch is a very big driver. So I prefer to own someone levered to the gaming console cycle versus the PC cycle, which is what you get in Turtle Beach, number one. I would also say that if you look historically at M&A multiples, generally these businesses have traded no less than 2 times revenue. There's been several examples of that over the last bunch of years. So I think the evidence points to that they're extremely undervalued. But more importantly, I think a really important tenet for us at Windward is capital allocation and shrinking shares when you're trading below your intrinsic value. So, legendary interim manager Jeff Gandel, Tom Team, their strategy is to buy every share until there's 1 share left. And that's what we believe in as well. And hopefully we're that last share that we own. And we think that this board gets it. We're very confident that they do, and that they're going to continue to say, look, either the market's going to reward us at 8 to 10 times EBITDA, or we're going to take our free cash flow every year and buy back stock until we trade there. And we also feel very comfortable and aligned with management and the board that they're not going to do some stupid dilutive acquisition, and they understand there's execution risk. So with their stock trading on our math, closer to 3.5 times EBITDA pro forma for free cash flow and buyback, we think that they're going to buy back every share they can. Now, look, if the stock goes to 7 times EBITDA, this has become a little bit more of a nuanced discussion with the board to say, hey, look, we could drive scale synergies through a deal, and maybe we could buy something accretively at that multiple. And I'm game for that. But at these levels, I think they're going to buy back and hoover as much stock as they can. And I think that we will start to see that very shortly.
I love the taunting and everything. Obviously, those guys are legends, but I love it because most of my companies, I like to have some form of buyback, and I'm like, oh, they're going to buy back shares, and we're going to find out, what happens when you buy back the last share, that old joke. But I will say, every company that I thought I would get to a point where they bought back the last share, they run into a train wreck of some form, and then inevitably the management team stops buying back shares. Let me actually start there. Look, it is not lost on me. I think when they do the PDP deal, they say they're going to do a big tender offer. Importantly, they say alongside the tender offer, if I remember the call correctly, directors and insiders are not going to participate into the tender. I believe they call the tender off, and then they do some pretty nice share repurchases. But it's also not lost.
Let me interrupt. They didn't call the tender off. The stock ripped through the high end of the tender.
Oh, okay.
The stock went to 18, and the high end of the tender is 15. And I think that's actually a great point, because let me provide some color to the audience. That actually was a lot of brain damage for us, because what happened is they announced this tender, and they studied all these tenders, and they said, this is the highest premium we've ever, we got all these bankers look at this, and it's the highest premium that we felt comfortable doing. It's like a 25% premium. But they announced a tender on the same call. They announced an accretive deal that doubled their EBITDA. So doing a 25% premium on a doubling of your EBITDA estimate from 30 million to 60 million, nobody's going to give you stock. So what happened is you had a bunch of event people pile into a fairly illiquid stock, thinking they were going to raise the tender. They didn't raise the tender, and now and I'm sure you're familiar with the event crowd. All these event people are now stuck in a stock they don't necessarily want to be in. They thought they were going to get an arbitrage on a tender, and now have had to drip out of the stock over the last bunch of years, which is a part of the brain damage on why the stock only really first recovered into the high teens in Q1, and then obviously we get hit with all the tariff stuff, which I'm sure you're going to segue to at some point as well. This stock was $19 literally a month ago, so we think that they're very comfortable.
I've got a lot of stocks that were 19 a month ago and aren't 19 anymore.
But they're probably not going to buy back a third of their company.
Let's start with tariffs. I mean, you pitch headset company and gaming handsets, and the first question everybody's going to ask is, hey, all the handsets are coming from China. Say again?
That's not accurate.
I mean, all the handsets are coming overseas. Tariffs, right? Whether it's the handsets are getting produced here, but all the parts are tariffs. That's all anybody's going to talk about. So why don't we address, I think they talked about it on the Q4 call, which was only a couple weeks ago. They said it's built in the guidance, but why don't we just talk about tariffs?
Yeah, look, you could also go back to the ICR commentary. I think they're sandbagging a little bit on the tariff stuff. If you listen to what they said at ICR, they've moved a lot. So under the prior tariff headwinds from 4 or 5 years ago, whenever it was, they moved a lot of their manufacturing outside of China and to Vietnam and other locations. Number one. Number two, so they are paying themselves for the full headwind of tariff, but not giving themselves any credit for pricing, which we think that there's quite a bit of opportunity for them to raise price. And number three, we think that there's, in a environment where we might be going to a softer consumer environment, obviously we've seen a lot of signs of that, gaming is a low-cost way to entertain. So, and then the last thing I would add, which we like multiple ways to win, is that there is this kind of impending tailwind of this replacement cycle from COVID that we haven't seen yet. And we've talked to countless number of industry people and experts that are saying that we're at literally the 1 yard line of starting to see this bulbous of replacement coming from COVID, which the industry has not seen yet. So we think that there's a lot of offsetting factors against some of the headwind from tariff. And then obviously in addition, all the tailwinds in the industry on Switch and GTA 6.
Let's talk about the headwinds. So GTA 6, I'm here for that. Or sorry, tailwinds. I'm here for GTA 6 as a tailwind. It's going to be, I'd be shocked if it wasn't by far the biggest gaming launch of all time. It's going to be a blockbuster. Why do people buy headsets? Because they're about to drop 100 hours into GTA 6. They're going to play online. They want to talk clear with their friends. 100% believe it. Nintendo Switch, the company thinks it's a tailwind. I think analysts, I just want to push back on that a little bit, because when I think Nintendo Switch, I have one. I love playing Mario Party. I don't need a headset for it. Everything's online. It's more, when I think headset, you think intense gaming. The Battle Royale cycle was a big driver for these guys in 2018. You think intense gaming, you think firefights, needing like the most. Nintendo Switch is more casual. So when I think about Switch 2, I think more casual. Now, they do have, as you mentioned, they have the handsets for the Nintendo Switch. They've got the license for that. But when I go to their website, everything is pointing me to Xbox. Everything is pointing me to PlayStation. Switch, not so much. I don't doubt that they're going to see a little bump from handsets, but again, maybe it's just because I'm old and I very rarely video game.
It's a good point. So yeah. First off, Switch is a very big component for PDP. So if we break it down, right, Nintendo is a very big component for overall PDP. So for sure, it's a massive tailwind to PDP. For Legacy Turtle, they had no license with Nintendo. So now being able to leverage a license with Nintendo into a massive console launch, it certainly is going to be a tailwind. I'm not arguing that Switch is as big as GTA 6. That's not what I'm saying. I'm saying that a console launch of this magnitude will be a tailwind to the company, and they are not guiding for that benefit to be a tailwind to Legacy Core Turtle X PDP.
Makes sense. Let's talk about the share repurchases real quick. So as you said, company's got a big working capital buildup. Hopefully this year you get the double combo of working capital release plus revenue growth and earnings growth leads to a huge inflow of cash, and they can buy back a ton of shares. Just look at it. Q4 was kind of their lowest amount of share repos since the PDP merger had gone through. Obviously, there were the tailwinds, but I look at that and I say, hey, are these guys really are we gonna get the big capital allocation tailwind, or are they gonna look around and say, hey, maybe we do another acquisition? I just always worry, because as I said, I always think I'm gonna be last year outstanding, and the company lets me down and doesn't buy till there's nothing left.
Yeah, that's why you have to be in the weeds to understand what's going on. We think that they were pretty close to tapped out, given the covenants as it relates to the Blue Torch term loan. We think that there was not a lot of capacity left to be able to buy back stock. So, if you read the covenants there, I mean, there was a pretty significant prepayment penalty if they tried to pay off that pretty egregious term loan of SOFR plus 7.25 until an anniversary, March 14th, I think it was. So you really are in inning one of these guys being able to refi that facility and move on to something more flexible with much more attractive TTM EBITDA and go forward EBITDA. And like I said, they had execution risk on PDP when they were going to do that buyback last year. Obviously, that's now nil. So I don't know. We could be wrong, but our view is that we would be shocked if buyback this year wasn't at least market cap here is 20, call it 300. I'd be shocked if buyback wasn't at least a quarter of the current one.
And if I remember correctly, they amended the Blue Torch loan so they could buy $30 million before the end of March, which is past at this point. And I think they can start getting into it now. One more question. Company has said long-term targets, 10% plus revenue growth and mid to high teens adjusted EBITDA margins. They're basically at to mid to high teens adjusted EBITDA margins. So, if somebody wants to come and say, hey, cyclical industry, whatever, I think they've proven they can get to mid to high teens. 10% plus revenue growth. If I just think about the headset market, it doesn't strike me as a 10% plus long-term revenue growth market. It seems pretty saturated. Yeah, you get the console cycles, but that's temporary. That should be kind of built into it. I just want to ask you, do you think they can hit that 10% plus long-term revenue guidance? Because
I think 10% revenue guidance is hard to hit for anybody. I mean, that's significant revenue growth. The stock doesn't trade. This stock trades like it's declining revenue, not 10% revenue growth. So look, we feel very comfortable that, mid to high singles organically is realistic. And a business that has high teens EBITDA margin, throws off a ton of free cash flow and grows organically mid-single, should trade no less than a 10% free cash flow. So, I mean, you're talking about a double just on that without accretion from buyback. So yeah, but it brings up a good point, because our upside case isn't really 10% revenue growth, trade at 15 times EBITDA. Our upside case is, this is a company that shouldn't be public. It's illiquid. It was a one product company. They diversified with buying PDP from Diversis. We think the game plan is allocate capital appropriately. When your stock gets to a more normalized level, do another tuck-in M&A deal that is accretive, buy it at 4.5, 5 times pro forma for synergies, get your EBITDA over 100 million, which they're pretty close to doing, and then you become a more scaled, attractive candidate for a Logitech to acquire. And something like a Logitech or a Razer that wants to IPO and could potentially reverse merge into Turtle, you are able to buy Turtle at 10 times stated EBITDA. By the way, Logitech has almost $2 billion of cash, and they're buying, which crazy to me is they're buying back their own stock at 17, 18 times EBITDA. It's much more accretive for them to buy Turtle than buy their own stock. But what I think the end game is that they buy back their stock, do another tuck-in deal, and then sell to somebody at, call it 10 times EBITDA, which really looks like 6.5 or 7 times, for a bigger player, which would be half or less than half.
So that was actually my last question. What is the end game here? But let me just pick at it a little harder. Do you think strategics would be interested? Because as I mentioned, Logitech, you Google headset, Logitech's already got headset. It seems like the great thing about PDP was Turtle Beach had headsets, and you sell a headset to GameStop. You buy PDP, and maybe you could go to GameStop and say, hey, why don't you buy the headset and give us a slot in your handset market as well, right? Logitech goes and buys Turtle Beach. They say, oh, cool. Yeah, there's some synergies, but we already have headsets. We're kind of we're buying another headset manufacturer. It doesn't make sense. So do you think a strategic has interest, or do you think this is a private equity platform?
I think both could. Speaking to your point on Logitech has a ton of share in PC. On console, and Corsair is another example, why Corsair in many ways elegantly makes sense is because if you look at the share in PC versus console, it's very elegantly inverted, right? Roughly, these are rough stats, but call it Turtle is like 80% console, 20 PC. Corsair's the opposite. So there's a tremendous amount of synergy to be able to acquire Turtle and benefit from cross-selling and public company synergies. And there's a lot to be done there. But look, just financially, just from a financial engineering perspective, from Logitech's perspective, in what world does it make sense to buy back your stock at 18 times EBITDA when you can buy a business at 5 times pro forma for synergies? It doesn't make a lot of sense to us unless it's just not big enough to move the needle, or you have a very negative view of Turtle Beach. But I think Turtle Beach has been proving out that they continue to take share and grow margins. Look, I think it makes a lot of sense for private equity as well. Obviously, a private equity firm won't be able to pay the same multiple that a strategic can, but we think that private equity could clearly take this thing out for 25 plus and generate a really attractive IRR. But we think the Grand Slam case is, this could be worth $50 if we're right and they shrink their shares the right way. And Nintendo Switch and GTA 6 work, and you're looking at, an EBITDA estimate pro forma for another tuck-in deal that's $100 million in 26. We think at 10 times EBITDA, this thing is north of $50. So we just think it makes more sense strategically, but wouldn't be shocked with all the private equity money sloshing around that it ultimately goes to PE.
What keeps you up at night with this name? Because I hear the thesis and it sounds really good, right? Say, hey, 5.5 times our EBITDA. The peers are trading at least double, maybe more. They're still annualizing the acquisition, so probably a little bit more, at least on the cost synergies. Maybe the revenue synergies start coming in. You've got a board. The company keeps saying we are going to buy back like crazy, and at the end, you hopefully have some, back half of the year, you have some tailwinds from the console launches in GTA 6. And then at the end, you have a board that hopefully is pretty aligned with selling this either to a financial or strategic buyer. So when I lay it all like that, it's like, hey, this sounds really good, right? Which is why you're a 13G filer and everything. But because what keeps you up at night? Because one pushback I would have is go pull up the stock chart here, right? And it is a new management team, which is absolutely critical. But it's one of those companies that yo-yos up and down. But if you had invested, 7 years ago, you're basically flat on your investment. So great trading sardine, but it hasn't really created any value. Now, cheaper multiple today, new management team, all of that I'll grant you. But I think you see where I'm going.
And it's a great point. We generally look for businesses where the value has been created intrinsically, but the market's not reflecting it. Think about the tremendous value that these guys generated through the PDP acquisition, the free cash flow and deleveraging that they've done. And the stock is lower than when they announced PDP, with a lower share count, lower leverage, higher EBITDA, lower share count, more attractive cash flow profile. I think some of the damage, which we talked about a little bit, was the failed tender, which I actually think was a bigger deal than probably most people do, because I'm looking at it more from a technical trading perspective. This is an illiquid stock, so you ask me what keeps me up at night is the illiquidity. Now, illiquidity is your friend if they're buying back stock. So my biggest concern is that they don't do what I think they should do, which we're very confident they will. But if they don't buy back stock, I'm going to be pretty furious. And that would concern me. If it's, hey, they're going to do what they should and buy back stock, I sleep very well, because if they're buying back a third of their company and they're trading at this type of multiple, I think that the risk reward is extraordinarily attractive. That's why we love capital allocation so much. If this was not a buyback story, our bullishness level would be significantly lower. It's the catalyst of the buyback imminently coupled with these inflecting tailwinds to the fundamentals, which is really what we do in every stock that we really like. But the timing on this just happens to be really unique in that we think it could be, any week now.
There is the private equity firm that sold them PCP owns, I think about, say again?
Thesis is the name of the private equity.
They own about 20% here, 13G filers. Do you think everybody is aligned with the buyback share story? Because yes. I agree with you. I think that's the most attractive piece of this story.
Yes, I do.
It's a simple answer. Look, it is, as I said, you can sum this thesis. One of the things I like, you can sum the thesis up, in 3 sentences: cheap, buybacks coming, tailwinds, trades at half the multiple. We've talked about the risk. We've talked about anything else we haven't chatted about that you think investors should be kind of on the lookout for here?
I think we covered most of it. I just think what's interesting is just the euphoria around gaming that we entered the year with. And, where some of the other comps are trading, and a lot less of the brain damage, right? With like a Logitech, which is traded off a little bit, but relative to what Turtle's done, it's just interesting. So I think for people that, can bear a little bit of the liquidity issues, I just think that, you have a very exciting catalyst here. And we really can't overstate more how bullish we are on the capital allocation. And we do think it's very timely.
No, look, I agree with you. Again, it's the capital allocation story that really gets you going here, because they have the, I guess we can talk timing, right? When do you think the share buybacks really start? Because as we mentioned, Q4, they kind of really dial it back down because they're seeing the tariffs, they're seeing the inventory build up, all that sort of stuff. They've got the restrictions and that government. Do you think it is a now event? Do you think it's, hey, a Q2 event, back half of the year?
I think it's now. I think it's between now and the call. I'd be shocked if between now and the call this didn't happen. I mean, in a perfect world, the way I see it, and obviously I'm just trying to read tea leaves and, make my best, intuitive guess. You have Blue Torch expiring. Refinancing a facility is not the easiest thing in the world, right? You got to be competitive. I would assume that the market backdrop probably only lengthens that process. So you kind of have Blue Torch expiring on the day you reported earnings. If I had my druthers, the way I see it playing out is they kind of figure out a flexible facility that allows them to take down a ton of stock, and perhaps maybe they pre-announce earnings in the next week or two with a massive tender. That's how I see it playing out.
And look, as we mentioned, the stock ran through the tender, so they pulled it, but they generally history's the best guide, right? One of my favorite things is if a company tried to sell themselves before and it fell through for one reason or another, they're probably more likely than your average company to sell themselves again. This is a company that tried to do a tender offer once. Betting on a tender offer anywhere is always kind of a long shot odds, but it kind of makes sense if they're seeing what you're seeing and they're getting a big influx of liquidity. They tried to do it before, probably tried to do it again.
Well, the other thing also with the tender, we've obviously, shared our view on it. When you're an illiquid company, a tender makes more sense, right? If you have a tremendous amount of liquidity to buy back stock, I think a 10b5 or an ASR or other forms of turning capital shareholders to buyback could make sense. But the problem is how much stock are you actually going to get in if you're just sitting there buying back 25% of the stock every day? My guess is you're 12 million in, the stock's back at 17 or 18. So I think especially in this market backdrop, there's probably people that would hit the bid. I almost think this market backdrop is the best thing that could ever happen to them, because there's hedge funds out there that are underwater or whatever. And, they're like, okay, tender up to 16 or 17 or whatever it is, boom, hit the bid. And all of a sudden you've got 3 million shares put to you because people are happy to take that P&L. So I just think the liquidity almost demands to a certain degree of tender for this company. And I think, I hear you, once bitten, twice shy, you try to do a tender and it failed, but you also try to do a tender when you doubled your EBITDA estimate. I mean, it's not the same thing. So I just think it's a different animal this time around.
No, I love what you said on liquidity too, because I talk to these companies and they'll say, hey, we can't do share buybacks. Our stock's already too illiquid. Like, yeah, you can't do a big share buyback because your stock's illiquid, but why are you worried about lowering the liquidity? Like, these guys are sellers. If your stock's at 10 and you tender at 12 and everybody's hitting it, they're sellers. Just like if you think your stock's worth 25, take everyone who'll take you out at 12, then go do it again and do it at 14 and just keep walking it up until, I just love, for some of these, I just love to be the last share outstanding and have it happen at some point.
And listen, you have to find a management team and a board that's aligned with your viewpoint. I think that's more than half the battle, right? If we thought that we were speaking a different language, we wouldn't be as bullish as we are, right? It's not just finding the situation, it's finding the right backdrop and the right situation and the right board and management team that kind of have a similar vision to what you have. And a la Groupon, right? Finding the right people to execute and do the right thing. So we feel, we could always be proven wrong. You don't know anything for sure, but, we think that they're going to do the right thing. And hopefully that happens sooner rather than later.
Perfect. Let's end it there. Marc Chalfin, Windward Capital, this has been great. Second time repeat within a month, maybe third time, maybe we'll push it out a little bit further. But the ideas are always very interesting. And I will tell you, I followed this story for a really long time, and it's the most attractive it's ever been to me. So, yeah, Marc, it's been great. Thanks for coming on for a second time. Looking forward to the third.
Thank you for having me. Appreciate it. Have a great day.
Today's podcast is sponsored by Dalupa. Are you ready to cut through the noise in AI and discover the real impact it's having in financial services? Join me alongside Thomas Lee, the CEO of Delupa, on April 15th at 1 p.m. Eastern for an exclusive webinar where we'll dive deep into the future of AI tooling in finance. We've all heard the hype, but what's the truth behind the tech? We'll discuss how AI is transforming financial workflows and where it's actually delivering value. With Thomas's experience leading a fundamental data company that leverages AI, you'll get firsthand insights into what works and what doesn't in this space. Whether you're managing a hedge fund, analyzing financial data, or simply interested in how AI is shaping the future of finance, this webinar is for you. Don't miss out on valuable insights from industry leaders. Register now at delupa.com/YAV webinar. That's Delupa, DALOOPA.com/YAV webinar for the April 15th, 1 p.m. Eastern webinar, and get ready to uncover the truth about AI in finance. A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.